If you took all the stock markets in the entire world, they're, let's say, in the $60 trillion levels. But if I took all the real estate markets in the world, including housing, it's 230 trillion US, 4 times as big. And if I take housing out of it, the commercial real estate markets are at least $100 trillion. So if more of the world's wealth is in real estate than in stock markets, it would be reasonable to argue, shouldn't more of a client's portfolio be in?
When I'm looking at acquiring a property, because we're also investors in it alongside of our clients, I'm looking at this acquisition as if it's for myself.
The price of real estate investment trusts can be significantly swayed or moved based on human emotion. So our thinking was, if we wanted to invest in real estate for our clients, the most value-driven way was to go out and buy the actual real estate.
Really what we want to do is build a portfolio that you might hold on to for 10, 20, 30, maybe 40 years with no particular selling frame in mind. So the idea is you needed an open-ended pool where you can choose when you're in and when you're out. I would say those would be the fundamental differences.
I'd really truly believe that clients feel a sense of pride of ownership with properties.
Our clients entrust us with their family's legacy, and it makes me extremely proud that we've built the team that is able to deliver on that need that our clients have.
Welcome, everyone. It is a pleasure to have you here in Toronto on a beautiful evening and to enjoy this view as we launch into a real estate event. We would like to acknowledge that tonight's event is taking place on traditional territory of many nations and continues to be called home by diverse First Nations, Métis, and Inuit peoples. So, our real estate panel. With this format, we are able to bring a number of highly respected industry masters together to engage in conversation and to share perspectives on the industry with all of us. For those that I have not yet had the pleasure to meet, I am Danielle Skipp, Managing Director and Chief Legal Officer at Nicola Wealth. Tonight, there is undoubtedly a number of people joining us who know very little about our firm, brought by a friend or a colleague with the promise of excellent catering, we are known for that, and interesting content. So first off, thank you for the leap of faith in joining us tonight, and we will not disappoint. In a few short sentences, please allow me to introduce Nicola Wealth. We are an independent wealth management firm that provides innovative and strategic financial solutions to high net worth individuals, entrepreneurs, and accomplished individuals. High net worth families, entrepreneurs and accomplished individuals. Today, we serve clients across Canada with physical offices in British Columbia and Ontario, and with just over 400 employees. 2 years ago, we were half that number. We are a highly integrated team, and our purpose goes beyond money. Our purpose is to dedicate our expertise and to nurture relationships with our valued clients, to help them achieve their aspirations beyond wealth, to create personal and professional legacies together. Over the past 2 years, we have reacted and responded to the uncharted waters like everyone else. We are now at a point where we are moving forward to reimagine our future workplace with intention and intelligent planning. Our continued belief is that the physical office is very important, and we are working to bring our employees back with a workforce strategy we have branded Reimagining the Workplace. Through this, we will continue to improve our spaces. I was just out buying new furniture for our new Toronto office, which will be on the 8th floor of the building that we're in right now, double the size that we're in right now because our team just keeps building. So it's really awesome. The new furniture that's out there to make like offices like very fun places to come to work, I want it for my home. For us, our employees stand out as like number one importance for us. A company is simply a collection of people, one team. And one of our proudest achievements is our platinum recognition by Deloitte as one of Canada's best managed companies. Now, without further ado, I would like to introduce Ethan Astaneh, a Nicola Wealth advisor and the host of our podcast, The Wealth Exchange. Ethan is a key leader within our firm, helping to mentor and onboard our next generation of advisors. Ethan will present a macroeconomic overview of the factors that are top of mind for investors, and then we will introduce our real estate panel. Thank you and enjoy the evening.
We're going to jump right into it. So we're going to start with markets and economics. Globally, stock markets are down. You can see on the slide here that the S&P 500 is down 24%, European stocks and the Hang Seng around 23%, the NASDAQ composite at 31.5%, and the TSX has performed a little bit better at 13.8%. That outperformance is actually because of energy stocks. These figures are as of yesterday's business close. What you're seeing here is a price chart of the S&P 500. And at that first trough, we wrote a commentary called Are We Bear Yet?, in which we explained that a bear market is a prolonged period of market decline, and they can actually last around 18 months. It's very important to keep in mind that we're only 8 months through this one, and 18 months is the average. Now, as soon as we wrote that, of course, stock markets went on this lift of around 10%. And some prognosticators were declaring the bottom of the market is behind us. The next era of growth is nigh. But it turns out that that was just what we would call a dead cat bounce, okay? Now, this is common when you're in a bear market, is these temporary and short-lived increases of 10% shouldered in between periods of decline. And normally, when the stock market is doing this, we look to the bond market for a reprieve. But if today your financial advisor was Dwayne Dog the Bounty Hunter Chapman, he would say to you, you can run from risk, but you can't hide. And the reason he would say that is because this iShares index, which is a proxy for Canadian bonds, on a year-to-date basis is down 11.77%. The reason this is notable is because of how rare this is for both stocks and bonds to demonstrate a decline. In the last 100 years, that's happened twice, 1931 and 1969. Now, this pressure that's coming on the bond market is a function of interest rates increasing. Just last week, the Fed raised the funds rate to 3.15% with an intention to actually march it to 4%. And you'd have to go back about 15 years to the global financial crisis to identify a time when rates were this high. And for those who lived through the 80s, you say, well, it's not exactly a problem that rates are this high, and we would agree. It's not that they're at this level that's the issue. It's how quickly we went from a low base to the current base with these successive jumbo hikes in a short period of time. And they had to do this. The reason they had to do this is to deal with the three-headed dragon of inflation. Wage inflation, goods and services inflation, and the one that hurts the most, the cost of parking in downtown Toronto. Okay. So here you're going to see a chart where the white line with blue shading represents at any point in time the yield you would get on a 10-year US Treasury. The red line shows you what you would get on a 2-year US Treasury. It stands to reason that most of the time, for committing your capital for a longer period, you should get a higher return. And that's what you're seeing. But every now and again, you see this inversion occur. And you're going to say, well, why does this matter? The reason this matters is because if we go back 50 years and we plot on this other chart, and you see these circles, this is every time that yield curve has inverted, you'll notice that every one of those is followed by a gray column. That gray column is an economic recession. So just to be clear, in the last 50 years, with 100% accuracy, an inverted yield curve has predicted an ensuing recession. So let's pivot a little bit to geopolitics. And of course, the matter of the day is the dual threat, and we'll start with Russia first. The challenge, of course, is the war in Ukraine and striking a balance between making sure the sanctions are strong enough to prevent the advancement of military agenda, but not so strong that you grind the gears of global growth and energy markets. It's also actually to be seen whether or not they have any military strength, besides equipment. It seems to us that morale and soldiers are low. I read yesterday that Edward Snowden became a citizen of Russia. I don't know if he knows they're conscripting. They also have a weak economy. Despite being 4 times the size of the Canadian population, Russia's economy is actually smaller. And probably their biggest long-term issue is declining population. First, because of just the natural birth rate issue that they've got, but it's now been exacerbated because they're having this massive exodus of some of their best and brightest minds in information technology. China's dealing with a few economic issues. The first one, because of the zero COVID policy, there was an economic impact to that. But now what's exacerbating it is some pretty interesting declines in the property market. It's important to know that the property market in China is 30% of GDP. That's a problem if it's falling. And what's a little bit scarier is that the reason it hasn't fallen worse is because there's actually price controls in place. If you let that float, it becomes a little bit of a bigger issue. And then perhaps what happens in Ukraine will tell us, maybe, or signal to us the degree to which there will be a pursuit of Taiwan. Now, the other issue is the command and control over some of their tech companies. Tencent and Didi come to mind. And their declines are somewhere between 40 to 75% in the last year. And then, of course, they're dealing with a declining population for different reasons, namely the one-child policy that they've backed away from. We're going to switch a little bit to demographics next. Now, in his well-constructed book, Stephen Pullos explained that there are 5 tectonic shifts that governments are going to have to deal with from a policy perspective over the next 10 to 20 years. The first one is aging population and demographics. A group called Statista did this analysis where they took populations and they trajected them out to the end of the century. And there were some remarkable findings. The first is that China's population is actually already in decline. And by the end of the century, it's expected to be 50% of its current level. Even a country like India that appears to be growing is actually going to crest and then end up declining by about 300 million by the end of the century compared to today's population. Interestingly, in North America, despite these declining birth rates that we have the benefit of rebalancing our population through immigration. Not many countries have this strategic advantage. Interestingly, where most of the population growth, the future growth will come from is Africa. Nigeria will be one of the leaders. There's also the technology revolution, moving at a faster pace than governments can keep up with. We're dealing with income inequality, which is causing political division. We've got levels of debt that are unprecedented, and you almost don't want to look at it sometimes. And then we've got climate change, which we're only just starting to understand. Now, in his book, Simon Sinek, The Infinite Game, he explains that this is actually going to overwhelm governments. And actually, it's on companies to fill this void through stakeholder capitalism and ESG. Now, this is something that we believe in with our share the pie philosophy at the firm, but we would take it one step further and say it's also important to focus on things like sustainability, equality of opportunity. So it feels like a bit of a perfect storm. You've got all these issues, and sometimes clients will say to me, Ethan, we've done this before, we've been through this, but can you just tell me, is there light at the end of this tunnel? And to find that light, I'd say, yes, there is. And we're going to refer to an old friend who helped us at a time of conflict and economic distress. Sir Winston Churchill said that a pessimist sees the difficulty in every opportunity, and an optimist sees the opportunity in every difficulty. So what are your opportunities today? Simply put, it's asset allocation. What is asset allocation? It's the strategic mix of risk-based assets such that you get a superior return for lower risk and volatility, okay? So what does a good asset allocation look like? If we take the top pension funds, the 6 of them in Canada, some of the best pools of money that are being run out there, what we observe is that over 40% of them, over 40% of their assets in 2018 and 2019 were held in private investments. And we know, even though they haven't posted the data, that it's even higher in 2022. So what are we doing to find value for our clients? And for those who are new in the room, it's important to know that the entire existence of our firm was built around the goal of delivering to our investors a superior return above what public markets can deliver. So what are we doing today in that effort? Well, we're focusing on real estate, which we're going to be talking a lot about tonight, specifically a heavy weighting in industrial and residential, which has done very well over the last little while. In fact, I'd like to give a credit to Mark and the entire real estate team. We just published our August results, and our Canadian real estate pool, as of the end of August, 12.4%, our US real estate pool, 19.2%, and our value-add development pool, 16.2% in this year. Those are good returns to get in any year, let alone a difficult year like this. We're also repositioning assets, which includes rezoning it for a different purpose. That adds value. We're also focusing on special situations like self-storage. When I was in my 20s, I had about $1,200 worth of stuff, and I paid $250 a month for 3 years, okay, to store it. Trust me on this, you want to be on the other side of that equation. We also build to own, which is something we're going to talk about in just a second. In fixed income, which is challenged, as I mentioned, in the bond market, we're not really using bonds much. We're focusing more on private assets, specifically mortgages and private debt, which, as interest rates rise, will help capture that for investors. So it's got a natural hedge built into it. We're also using separately managed accounts, which is a structure that allows us to increase our flexibility into accessing deals while actually pushing down fee structures. And then we're not keeping exposure to long-term bonds, given the economic environment. In terms of the way we manage equities, we've always been a fan of directly managing them and focusing on value and cash flow. These strategies weather economic times like this well, and actually they'll recover before growth-oriented strategies, which we don't preclude from the strategy, but we focus on growth areas that we think are going to grow faster than the overall economy, like renewable energy and technology. So what does our model look like? In the bottom left pie chart, it's a little bit busy. It gives you the granular details, but it actually rolls up to 3 main categories. We have about 1/3 invested in real estate for our clients, about 35% at this present moment in public and private equity, so not all of the ownership is in public stock. And then we've got fixed income, as I mentioned, heavily weighted in mortgages and private debt right now. How has the model performed? If we go back and you invested capital at the beginning of January in 2000, you wind it forward to today, 22.7 years. If you invested in a basket of global stocks, 4.72% would have been your annual return. The S&P 500 would have done a bit better, just over 6%. The TSX Composite, 6.53%. And if you couldn't stomach that volatility, you would have used a balanced fund, 60-40 stocks and bonds, and gotten about 4.5%. Our return has been just over 7% net of fees on an annualized basis. Superior performance for less volatility. How would it have worked in dollar terms? If you started with $1 million, you would have $2.69 million if you followed that Morningstar balanced approach. And if you used our model, it would have been $4.64 million. That's $2 million almost of differential on a $1 million capital investment. Now, long-term performance is useful, but we also wanted to dissect short-term performance. When you have an economic event like this occur, what happens in the 5 years that follow? How does a 60-40 stock bond portfolio perform compared to our model? Now, we went back to 2008 to look at this, and we said, well, we had a 5.1% return annualized for each of the 5 years that followed the first event in 2000. That 60-40 portfolio was down 2.1%. So that's a differential on an annual basis of over 7%. In 2008, the outperformance was closer to 3%. And so far this year, it's been significant, but in fairness, it hasn't been 5 years. It's been a much shorter period of time. The bottom line in the conclusion is that in these distressed environments, private assets like real estate and private equity make a big difference, specifically when equities are overpriced. So, real estate is not just, private assets are not just a productive asset from an investment return. From an after-tax basis, they're also very efficient. And the reason is because in these pools, what we can do is we can use depreciation to reduce the taxable income that gets distributed to our investors. And because we're acquiring new assets in the pools at all times, we can perpetuate this. What also happens, and because of the capital gains inclusion rate right now being 50%, only half of a realized gain would be taxable. The other half is not. This one you would have to check to see specifically if it applies with your own tax advisor, but in some cases, if you own specific types of real estate in a Canadian-controlled private corporation, it can be taxed to you as business income, which has a tax drag much lower than passive investments in a CCPC, which can be 50% or higher. And then, of course, we can synthesize a lower turnover of assets because if we need to fund another project, we don't necessarily have to sell. We can simply refinance. To put this into example for you, suppose we took a blended mix of those three pools that I was referring to earlier, our US real estate pool, our Canadian real estate pool, and our value add pool. And if we invested at the beginning of January 2016, we put $1 million in there, and we wound forward to today. So that's actually a 6-year period if you include it all. $1.958 million is the outcome. So that's $958,000 of gross profit, 11.9% return before tax. How much tax would you have paid? Well, over that entire period, $76,000, which would make your after-tax return 11.1%. Now, I mentioned build to own earlier. What does this mean? It means that before we take over, before we have an asset in our portfolio that we manage for the purpose of collecting cash flow, we actually want to be involved in the development of it. Why do we want to do that? The reason is because we can help our investors capture the development return of between 15 to 20% per year in the first 3 years of the project. That's meaningful and it makes a difference. It adds value. Also, we can build the assets that we want to build. The benefit of these new builds is that they also have reduced capital expenditures for the first 10 years, and that helps profitability when you're managing for cash flow. We also get to do our part in terms of global sustainability standards in real estate. There's also, in certain aspects of the real estate market, preferred financing that's available, which is very helpful in this high-rate environment. And finally, there's no tax to pay when you transition the use of the asset from its development stage to its long-term hold. So with all of that said, ladies and gentlemen, I'd now like to present and welcome to the stage our Managing Director of Nicola Wealth Real Estate, Mark Hanna, who's going to get us started on our panel discussion. Thank you for your time this evening.
My career in real estate started when I was 13. My father owned a property management company for summers and over the holidays. My brother and I did everything from filing accounts payable to working as a building operator. I've always been interested in being an entrepreneur. Northbridge Capital was founded in 2016 by my brother and I. We primarily invest into industrial, office, residential, and retail properties in both the US and Canada. One of the things that's great for us is being able to have this great dynamic. I can come to work every day, work with my brother, who is also one of my best friends, and then my father's here as a mentor for us.
I got hired by Ontario teachers out of school, and I was there for about 8 years. I ended up seeing an opportunity to create my own company, creating a company called Timber Creek, which morphed into Hazelview. We're an investment manager focused on real estate investments. So we're very much a value-add investment shop. We've always specialized in multifamily, where we thought that was a very good asset class to be in the long term. I get a real good kick at finding an asset that no one liked, that we're able to go in, roll up our sleeves, create the value, and surface that value where no one else has seen. And I think that's what I really enjoy about what we do here.
The best piece of advice I've ever been given is sometimes you got to tell the client not to do the deal. Starting in the early 80s in a market where real estate was a bad word, one of the keys in my business has been developing relationships, treating people with integrity, and I think that comes back to first golf and spades. We are in the office, industrial, and retail development business. We're also a contractor of all those asset classes. But our skill set is really on getting development approvals and executing on projects. I think people trust what we do and trust what we say, which is extremely important to how we run our business.
Working for Fengate is the job in the sense that we're investing, and it's critical that we drive returns for our investors, but first and foremost, it's what kind of impact are we making with the work we do. We look for large sites where we can do a mixed-use component to it. We like to be able to have condo, apartments, but we like the flexibility to be able to adapt the site to what we think that neighborhood or that location needs. I love nothing more than walking the streets around a project we're looking at, figuring out what just the vibe of the neighborhood is, and then tying that into the investment. It's kind of funny because when I drive around Toronto, there's so many stories that tie to real estate that my son and my husband are like, "Mom, could you stop telling us all the stories about all the real estate in Toronto?" We're the type of industry that we're so tight-knit. We all know each other, or we're one person away from knowing each other. And so we all know the stories around our projects. Every building out there, there's something interesting about how it got there.
Welcome everyone. My name is McKenna. I'm with Nicola Wealth Real Estate, and I'm going to be moderating the panel this evening. Ethan, I can't help myself, but the reason I like self-storage is here's what's changed in 20 years. Now people pay $12.50 a month to store $300 worth of junk. It's a beautiful business. Before we get started, we have a slight lineup change. You probably saw David Carrero in the video there. He actually looked like he had a code for COVID, which is unfortunate, but Andre has kindly offered to step in, and Andre Mihelic is Executive VP of First Golf. He's very experienced, and we're very happy to have you join the panel today. I want to thank all of you for coming today to this event. I think our audience is very lucky to have such a talented group of industry experts, and this is also a great venue to have this event, and Andre's fingerprints are all over this building. I think Ugo was just kidding when he was pointing out the deficiencies in the building here, right? Weren't you? Huh?
Depends.
Last week we had a very similar event in Vancouver. We had around 650 people, and we had it at the convention center in downtown Vancouver. Toronto is a really important city for our firm, both from a wealth management and a real estate perspective. I have the unique benefit of being able to travel to many cities in Canada and the US. And I'm not just saying this, but Toronto, I never thought I'd say this, but Toronto is far and away my favorite city, which probably explains why our portfolio in Toronto is the biggest part of our entire $8 billion portfolio. So in driving around the city, and I spent a lot of time with Adam and his brother and our team on Tuesday, there is a lot of brick older industrial buildings in this city. We don't have anything brick in Vancouver, but there's a lot. But I think this city is something you should be very proud of. I think it's just, I can't believe the growth when we're driving around. It just goes forever, but it's such a great city. Huge Blue Jays fan, huge Raptors fan, but I'm going to draw the line on the Maple Leafs. So, all of you performed very well in the video, so thank you. Jaime, I had to laugh because I do the same thing. I drive around with my wife and kids, and I get the eye roll.
Yeah.
Oh, really, it's all the real estate stories. But it's true in real estate because it is pride of ownership, and that's the cool thing about real estate. Before we launch into the questions, and I've got 7 or 8 questions that I'm going to ask today, I want to talk about a topic which is people. And as all of you know, and maybe the audience doesn't know, but just because you own real estate doesn't mean it runs on its own. People, you need quality people. And I often say at our firm, if I can take credit for one thing, it's that I've built an incredible team. And these people are passionate, they care, and they want to get great outcomes for our clients. So let me start with you, Jaime, and we'll go down the line here. Like, how important is people for you?
Well, Ugo and I were talking about this a little bit going through COVID, and what I've discovered is I am an extrovert. I do not do well in an office by myself. But what it did do for me is it emphasized how important my team is. I mean, put the assets aside, put the investments aside. Those are all really important outcomes, but getting up and enjoying the people you work with every single day, seeing talent grow and develop, that's actually the best part of my job. And actually getting to work with all the people in this industry, like I alluded to it in the video, which there's nothing worse than watching yourself on a video. And it was edited very well, by the way, Mark.
That's good.
But yeah, the talent, if you don't have the talent, if you don't enjoy working with them, then you're not going to perform as an investment manager.
Adam, you've been building a big team.
Yep. No, we started 2016 with just my brother and I, and our business wouldn't be anywhere where it is without our team. Our business is simple but complicated, so you need a lot of different skill sets in order to execute on something. And I think we all bring something different to the table, and that's what's great. And I think, also looking back in other roles and so many friends and relationships that you've built over the years, whether with brokers or colleagues, and it's all kind of one giant team working together to try and execute on these projects in a lot of times.
Ugo, how many people? You must have a big team now.
We do have a big team. I think this is a recurring theme. People is very, very important in what we do as investment managers. I think at the end of the day, people are our secret sauce, right? Without the people that we have, without the diversity of thought, with the different diversities in people we have around the table, investing is only about new ideas and creating those ideas and executing on those ideas. But those ideas don't come out. You need people. You need people that bring those ideas. You need the collaboration. You need the team to put it together. And for us, a great team, like any sport, a great team that works well together will always beat individuals that work they're on their own. And a great team of people that work hard versus a team of stars will always outperform. And our people are, in essence, what makes us what we do well. It's a secret sauce.
Andre, we've done all our work with your group for the last 4 or 5 years, and I've watched your team grow. So I'm sure you have a similar thought on talent.
Yeah, so Mark, I got your outline of the presentation yesterday evening, and I saw that you were going to lead with this question. And all I could think of to myself was, don't say our people are our greatest asset. I mean, it's such an overworn expression, maybe rivaled only by your health and safety are our top priority. So I actually went online and looked up, our people are our greatest asset cliche.
Yeah.
And the first thing that came up actually was an article in Harvard Business Review, and the article was provocatively titled, "Your people are not your greatest asset." And anyway, the article went on to explain, what is your greatest asset is empowering your people. And I think that's the one thing that Dave has done a really, really good job of at First Gulf. He's not here. I'm going to compliment him, even though he didn't give me a lot of time to prepare for this. But the one thing Dave, I can say, has done very, very well is empowerment. And he sort of set that tone, and it permeates the entire organization. And of course, what that means is that you have to have people that you can trust. You have to have people that are competent and reliable. And he's assembled that type of team, and everybody down the organization ensures that they empower the people that work for them. And I think for us right now at First Gulf, Mark, I know that you rank us as one of your top development partners, and we're very grateful for that. And I think the team we have right now in the 8 years that I've been at First Gulf is as strong as it's been in terms of execution capabilities, like top to bottom across the different functional areas. So I'm sure we're going to continue to be at the top of the heap in terms of your development partners. And I think that's the one area where I really have no concerns about our business, is our team and our organization and our ability to execute. We're going to talk later about some of the other challenges that our industry is facing and some of the headwinds, but for us at First Gulf, our team and our ability to execute is not one of them.
Yeah, I often say you can't teach somebody to care, so you want to hire, that's my first thing, is they got to care, right? Because then they're going to be passionate. Okay, let's launch into the questions. Jaime, I'm going to start with you on this. Let's start with interest rates, which are a very hot topic. I think over the last number of years, we've been spoiled with a low interest rate environment. However, over the last 7 months, interest rates have risen very quickly to help stem inflation. So how has this impacted the markets you're in and the products and the sectors you're pursuing? And I think the big question that everybody's asking, I asked the same question in Vancouver, is, so it'll be interesting to see what all of you have to say, is how do you think this is going to impact cap rates and property valuations, kind of in the short to medium term? And so for example, if the all-in borrowing rate right now for a commercial asset is, call it 5 3/4 to 6 1/4, do you think cap rates are going to 8.5%?
That was a really long question.
Yeah, I know.
I'd really try to pull that apart.
Pick which one you want to answer.
So, I mean, just from a real estate perspective, our portfolio is broken into 2 categories. We have core, and then we have development. So within core, most of our portfolio is fixed rate debt, meaning we take a lot of time to ladder the maturities of our debt so that we don't have everything coming up in 2022 when rates are skyrocketing. So it's less of a concern in our build, as you call it, build to own portfolio. Where it becomes more relevant for us has been our development portfolio. Within development, when you're building, you're using construction debt, and construction debt floats. We knew rates were going up. It's the first time in my career, because I'm really young, that we've seen rates accelerate at this pace. They accelerated a lot faster than we anticipated, but it hasn't changed our underlying philosophy that at the end of the day, Canada has a housing shortage. They have a shortage for industrial product. The fundamentals are still there. It's just we need to be really thoughtful in how we model it. To your question about do I think cap rates are going to go to 8%? I mean, I'll say no, and then they will. That's what will probably happen. But no, realistically, I mean, there is a correlation, right? This will be one of the first times, I think, since the late 80s that we do face the risk of negative leverage, negative leverage, I had to think about that, where our debt is higher than the actual return we're making on our asset. But that is that's something that happens that can work its way through the cycle. And again, real estate fundamentals, especially private real estate that's not subject to the fluctuations you see in the public markets, are long-term holds. They're not something that you should be reacting to a short-term rate environment. And again, just my last point is we do have to remember all forecasts right now show as much as rates are expanding, they're expanding quickly, we have some short-term pain. The view is that they will temper off once inflation starts to come back in check. So as long as you're not selling your portfolio in the next 6 months, you should be in good shape.
I'm dating myself, but in the 80s and 90s, there was no such thing as positive leverage.
Yeah.
It was negative leverage, and people forget that. And so you talk to young people in the business and go, oh, we've got to have positive leverage. So they think the cap rate's going to go up. So I'm in your camp with exactly what you said. So Adam, you don't use debt, you use cash on everything, don't you? How is it affecting you?
Yeah, no, I think, listen, obviously, about 3 or 4 years ago, we made the decision to take less debt than more. We're in the value add space, and unpredictable things can happen, and I don't think we would have predicted this circumstance now. So we're happy we made that decision. It de-risked it. I think when we look at the current interest rate environment, we think maybe there's going to be some opportunities out there that will benefit us from a new acquisition point of view. We're really focused our portfolio about 4 years ago on industrial and short duration leases. So we still feel really bullish about that. You mentioned the shortage, our kind of spiel is like interest rates and growth, right? So we have high interest rates, we have high growth, and those two things are offsetting each other right now in the industrial space. And in Toronto specifically, where we're focused, we think this is a really great story. Canada is only becoming a better place to immigrate to. Elton John, he's moving here at David Furnish, I saw. If you read the article about it, he basically pointed out that Canada is one of the most welcoming and best places in the world, and they want to be here and their families here, and they could live anywhere else. And I think that's a trend that for us in Canada we need to be aware of, because we're getting inbound calls from private equity guys from the U.S. who have heard that Blackstone's opening an office here and are saying, hey, what's going on in Canada? We're going to have another 2 million people here in Toronto in the next 10 years. And I don't think there's any city in North America that has that kind of dynamic behind it. So interest rates are definitely impacting things, but at the same time, we have this great growth. So it's about positioning ourselves to take advantage of that growth and offset those interest rates. So that's really what we're trying to do right now.
Ugo, you're a lender, a borrower, you're everything. So how is it affecting your world?
He's an expensive lender.
Yeah, he is, yeah. I won't be going to him.
Relative. Look, I think I agree with a lot what Adam and Jaime have said, but I think back in the 1990s, interest rates were much more correlated to cap rates. They were probably 1-to-1, and that was because most of owners or property owners were developers that use a lot of debt. Today, cap rates are probably less correlated to interest rates, and they're probably, when we've done the math, probably 0.4 to 1. And that's because there's a lot more institutional players in the Canadian context than there was ever before in the 1990s, right? A lot of institutional players that don't use as much debt. And I think I'm going to take a little bit of a different approach from Jaime, where to me, I think if there's going to be an impact on cap rates, it's going to be more on income-producing properties where people do like the spread, and they're going to say cap rate should go up to 8. But frankly, it's not going to go to 8 because no one's going to sell it at 8. So, we do long-term debt as Jaime does, and we like the cash yield that we get and get that spread. But I don't think there's much going to trade on income-producing. On the other hand, on development and value add, where a cap rate is a function of the valuation, but it's also, there's the other function, which we talk about, is inflation, which is growth. And right now, there's a lot more embedded growth, and you're adding what Adam said about people coming in, 2 million people, and how much growth rates are coming in. So a cap rate is a point in time. And real estate's moving into a discounted cash flow model where you have to take all the growth that you have in that cash flow too. And so a cap rate becomes much more relevant versus the total return you want. And I think once you overlay the growth that you get in the Toronto market, whether it's development or value add, the cap rate is almost irrelevant, and there's a lot less correlation to that. So I think I would like to buy stuff at 8 caps.
That's true.
And I don't think I'm going to get much out of it. So I think you're going to see a huge bid-ask spread over the next 6 to 9 months. And I think that will come over time. And I think the other part of it is that long-term bonds are 3%, which is inverted from the short-term bond, right? So that's not much different than what it was pre-COVID or 2009, 2010 when bonds were. So things will adjust, and people always overreact. And I think there's an overreaction. We're really seeing that overreaction in the public markets. And I don't think that's happening in the private markets. And so long story short, I don't think cap rates are moving much.
Right. So Andre, your firm also does a lot of development, so I'm sure interest rates are having an impact in your performance.
Yeah, I mean, certainly on the short end, in terms of construction loans, very big impact. It's hurting some of our underwritings. Now, I would maybe differ a bit from Ugo's comment regarding cap rates. I'm not sure that the correlation isn't that close anymore. I mean, I do take your point. Between income growth, you've got and cap rate compression. For sure, there's at least a disconnect. But I think if you look at 30 years of cap rates and bond rates, that correlation is still pretty close. I mean, it's not perfect. And I think the critical thing to look at, and Ethan touched on this with his opening remarks, is the yield curve. Because I think the yield curve is kind of an oracle, right? Like, it tells you you're going to have a recession, and clearly that's in the cards. And I think also when you look at that 10-year bond, I don't know, where's that today, around 3.2, and you look at where the spread of the cap rate, the 10-year cap rate was against a 10-year bond, while it may not be as closely correlated as it was 30 years ago, I think that correlation still holds to some degree. So I'm a little bit more nervous than you are in terms of cap rates and valuations. And I mean, are they going to 8%? I think it touches on something that Jaime said, right, about inflation. And I think that's sort of the monkey in the room and what's happening with that. It's a complicated subject. You'd have to get an economist up here to explain those dynamics between money supply, cost push, wage pull dynamic, wage price spirals, supply shocks, all that stuff that goes into inflation. I can't explain it. All I can tell you is that inflation it presents a very difficult scenario for allocating capital and making investment decisions. And aside from that, I mean, it's just how damaging it is for the broader economy. And so I mean, my question is, well, what's happening with inflation? We've been talking, the economists have assured us that, you know, what we've experienced as of late is transitory. And I sometimes wonder, is it transitory another way to say, well, let's just ignore it in the hopes it goes away? You know, when you have the governor of the Bank of Canada, Tiff Macklem, saying something like, you know, encouraging employers to really watch themselves on wages, I mean, it tells me that these guys are a little bit nervous about that wage spiral, that wage price spiral. And the thing is, you know, the reality is nobody, I don't think in this room, I mean, maybe there's some old veterans who've experienced periods of sustained, persistent, elevated inflation. And people don't really know what that means. Like, again, you look at 30 years of inflation data, we've been in that kind of 1% to 3% range for a very, very long time. And I mean, if we've gotten complacent, I think it's perhaps about inflation. So, you know, is this inflation transitory or is it more structural? I don't know the answer to that question. You have to get a smart economist up here to explain that. But I am nervous, you know, and you do see what's happening in terms of the long bond in the U.S. I mean, that just breached 4% today. So we'll see, because if that inflation, if that is indeed structural, like that is a beast. And I think, again, I'm speaking from what I read in history books, but that is something that's making me quite nervous. And you know, if they're going to go to 8%, that is going to blow a lot of underwritings out of the water.
So let's move on to the next question, because I've got another 7 important questions I want to get into. So Ugo, it's logical to start with you on this question. It's on affordable and market housing. I read an article that there's 65 million vacant homes in China. We don't even have 65 million homes, period, in Canada. That's insane. And Ugo, the solution is not to send Canadians to get a free home in China. That's not a solution, right? So with immigration on the rise that we've all acknowledged is going to happen, you know, we've got a really serious housing problem. How do you see the residential condo and the residential apartment market helping provide that needed supply?
Yeah, Mark, I think this is a great question. I think I wish I could take 65 million homes in China and bring them here because, frankly, we need them all. And I think the solution to the affordability and housing supply, or just housing in general, is supply. We need more supply in single-family homes. We need more supply in condos. We need more supply on apartments. And we need that supply put in where we were talking earlier about where there's transit, where there's infrastructure. We need that supply to happen soon. And we feel that a good rental market, a good supply of rental, also provides a good community feeling because it provides long-term housing for a lot of people. Now, the question is, how do you really increase that supply, right? Mm-hmm. And you have to be able to improve the timing that it takes for cities to approve new developments. Right now, I think Toronto is the worst city in North America.
No, Vancouver is.
I saw the stat, but it could be Vancouver now. But it's almost 54 months to get something approved, and that's ridiculous. You can't. And if you add as Adam said, another 2 million people, that doesn't wait, right? It accumulates. It adds up more and more, and you need that. And you have to differentiate between rental and condos. Like, there's no difference between development costs and DC charges on condos and rental. And I think there has to be a distinction between providing more rental, because as we know, building rental is all tight, but you need to have soft costs. Soft costs make such a big component of the development pipeline, and the governments need to work together. Density, we need more density in the cities. And I think one thing that we're really missing in the whole supply equation, that I think this is much more of a federal issue. Look, even if we had all the density in the world and all it approved, we can't build it. There's not enough trades. Yeah. We have a lot of the old trades retiring right now. So we need the federal government to really improve their immigration and get the trades back into Canada, where we do have people that actually can build it, right? We don't have enough people, even if all the capital is available, to build it. And so I think it becomes imperative. And the other thing about supply, Mark, is you have cities approve zoning, you have provincial governments that do rent controls, and you have federal that does different policies for immigration. They don't talk, and the only way, and somehow it's become a private developer to fix the supply issue. And I think all levels of government have to work with private organizations to fix the supply. It has to be a collaboration to fix a problem, because I do believe this is probably the biggest issue that we face in Canada is affordability, and it's really hard to build. And it's probably hard to build affordable housing. Probably developers like ourselves or owners, we should put some affordable units to the market, but in exchange to build more market rental. And I think that's the way of solving some of the affordability issues in the short term, because most of these issues are long-term issues, and governments think short-term. Yeah. And I don't think this is a 2-year fix, this is a 20-year fix.
Yeah, if you get speed to market, the supply and demand factor, the supply will take over and it'll make it more affordable. Yeah. And you can go down, we were talking about this earlier, you can go down to the US and you can be in the ground on a new project in 6 to 8 months. Here it's 2 to 3 years. It's ridiculous.
Or longer, yeah.
Adam, I know your group is dabbling in this right now. And
I wouldn't say affordable, unfortunately. But yeah, no, I think supply is a huge issue. I think we're not as in tune with it as Ugo and maybe Jaime are, but we've spent a lot of time trying to figure this out because it's obviously a huge market opportunity and gap if you can figure it out. And really we've come to the conclusion that like the land cost and the cost of construction really is prohibitive to provide, like your basis is too high in the deal to provide affordable housing. You can subsidize it with density and you can get to market a little quicker so you're not carrying those interest costs and other costs for a longer period of time. But I think we need a bigger fix, and I don't know, I don't know what the solution is, but I think looking to the US, I know a number of people down there who are involved in Section 8 housing, where they can go buy an apartment and get a 30-year AMI mortgage with a fixed rate, and the government pays the rent and the whole financial model's set so they know what it is for 30 years. At the end of 30 years, they get the building for free and they can build their portfolio that way with no equity in. So I think we also need to be looking at our other jurisdictions and places and seeing how they're able to engineer this to create incentives for people to take a lesser return in the interim. And I think those are some of the ideas that we need to be exploring.
I like the idea of incentives because there was an article in the Vancouver Sun just a couple of weeks ago where Prime Minister Trudeau came out and he gave an interest-free loan to one of the First Nations group to build affordable housing, which is great. And so, but the private sector needs that too, right, to provide incentives. So, Jaime, what is your...
Well, I mean, to Ugo's point, the coordination at the different levels of government just doesn't exist. So there's no consistency city to city, province to province across the country in terms of how they're supporting us to create affordable housing. In some cases you see some, in Quebec, it's, they introduced the 20-20-20 rule, or in Toronto, it's the inclusionary zoning. So there's a use of a hammer to say, thou must do this, but there's no program or clear communication back to developers that say, but if you do this, this is the offset. So to Ugo's point, I mean, additional density, it could be forgiveness of land pricing, it could be forgiveness of property taxes when it comes to affordable rental. For us, one of the things we've started to do is that more from an ESG perspective, which we'll talk about later, is where we can't make affordable work en masse, can we do five units? Right? Can we bring a new Canadian family in and give them super cheap rent just to get them started? And maybe as a development community we can do that and we'll start to make a difference. But that's just a nick in the armor.
Andre, how are you approaching this?
Yeah, I mean it's an interesting. The whole housing discussion is very interesting. As you know, the other side of our business, our sister company, Great Gulf, is heavily involved in both high-rise and low-rise housing, both here and in the USA. And I mean, it's an interesting, the whole immigration discussion is quite interesting, and I know this isn't a public policy discussion, but some of Ethan's remarks at the outset were interesting about what's happening with population globally. And another book that I'd recommend is on the subject of population is called Empty Planet by John Ibbotson. He's a columnist for the Globe and Mail. He works here in this building. But the reality is global population has probably already peaked. And other than in Africa, it's on the decline in a lot of places. And so, globally, you're competing for people. And I mean, Canada is in a very, very advantageous position in that respect because we have a long history of immigration. We do a great job integrating immigrants. And I mean, it's remarkable. I mean, I think everybody on the panel can probably share their own anecdotes, but I look around our office, We have a young lady that we have in our construction group who's from Kyrgyzstan. She got her architecture degree in Turkey. We hired a controller not long ago who was a computer science graduate from India, and he took up accounting when he came to Canada. Again, I mean, both of these people are just razor sharp, great additions to our team. I was at an event on Saturday night where I just got to talking to a couple of people. One young woman, she's a master's in mathematics graduate from the University of Tehran, Iranian. Another young fellow went to the American University in Beirut, a Palestinian fellow, worked in Dubai, came here. But like everybody's got those stories about the kind of the quality of the people that we get in this country. And so it's immigration and Canada's competitive advantage in terms of drawing those immigrants is a huge advantage. But of course it relates then to housing. I mean, how are you going to house these people? And for the last decade, I think average immigration numbers were something around permanent residents was something like 250 to 275,000 people a year. And that was both liberal governments, conservative governments. Liberal government has recently announced that they're going to up those numbers to around 400, 450 a year. And I mean, I know this is a question that nobody wants to touch. We're always talking about the supply side of the equation. We're never talking about the demand side. And there's a great article by Howard Anglin, who was the former deputy chief of staff for Stephen Harper in Hub. It's an online journal, and he touches this subject, and he says that people are afraid to talk about it because they're afraid that they're going to be tagged as xenophobes or something. But the reality is, I mean, Canada had in the 70s immigration of about 100 to 175,000 people a year. Through the last decade, it's been around 250,000 people a year. We're now upping it to 400 to 450,000 people a year. I mean, is that too many people for our industry to support in terms of supplying housing? And forget about housing. I mean, there's all the other infrastructure. There's hospitals, schools, transportation, recreational facilities. So it's an interesting question, and I don't want to digress and get off into a public policy discussion, but I do wonder about that piece of it. And then maybe the last comment I would make, more just pertinent to the discussion on what we can do. I think technology is going to play a huge part in how we can supply housing. And again, it's been interesting to watch some of the missteps of companies like WeWork spinoff We Live in terms of co-living, some of the micro housing, manufactured housing providers. But again, there's so many creative people out there with creative ideas. I saw this prospectus for a company called Cosmic Buildings. This is a US-based company, and their mission is to build micro-urban housing off-grid at scale. And I mean, it sounds kind of a wacky idea, like you're going to build housing off-grid at scale for urban environments. But it's that sort of creative thinking that I think is going to help deal with some of these issues. Again, because Ugo's right. Like, you can talk about developers' inability to provide. You can talk about cities, and policymakers' inability to get approvals. But the industry only has a certain amount of capacity to deliver these houses.
So. When you talk about immigration, is our government even competent enough to process these people, to get them in? I mean, that's the first question. So, anyways, let's not go there. Let's move on to the next question. Adam, you're up. This is on office space, the office sector. So we're now 2.5 years into when COVID started in March 2020. That asset type has probably been the most impacted because many of the office towers have been empty. Companies have had their staff remain at home for the most part. Real estate actually has been in the office almost since day one. We were talking about that. It's the real estate industry so collaborative. We've all been working. We maybe took a month off, but we've been back right shortly after COVID started. But what I find truly amazing is that even though these towers sat empty, companies globally still paid the rent, which is truly amazing.
Well, first of all, I'm a reformed office investor, so now I'm an industrial investor, so I'll give that as a starting point. But I think, listen, office has been very challenged. I think the biggest headwinds are the longer that we've been locked down, the more accustomed everyone has come to working from home, and different work patterns and strategies have emerged. I think everyone knows, that's been talked about a lot. I don't know where the occupancy is in our downtown office towers, but it's nowhere near where it was before the pandemic, I don't think. And hybrid work from home for a lot of companies is a reality. And, for the 20 years that I've been involved in the office space, these things have shifted. At first, everyone had big offices, and it was open concept, and now it's work from home. And so workplace strategies are constantly ebbing and flowing. But office has definitely borne the brunt of COVID-19. I think, on a kind of high level, going into the pandemic, the office vacancy rate downtown, still the buildings there, was about 3%. And that was the first time it had been 3% ever in my career. And it was the first time where landlords could really set the price and drive the market in any way they wanted. We're sitting today at direct vacancy at like 8%. And if you had asked me in 2007 when I was leasing office buildings on Bay Street, I would tell you that's a kind of a balanced market. So I think that there's perspective is important on this. And I think when I talk to some of my colleagues in the brokerage business, they'll tell me that we're adding another 5 million feet. There's probably availability of 10% downtown. So, the rates are going up and tenants are looking at their options when they renew. So you're seeing renewals at 50 to 25% less space. So we probably have a lot of inventory built in to chew through. And I think talking to some of these guys, you're seeing a tale of two cities. You got the downtown market close to transit and A buildings, like we call it flight to quality, and people want to be there. And if they want to make it easier for their employees to come to work, they want to have more amenities there for them. And what we're seeing in the suburban markets is a lot of those jobs, in a way, are less. They're more clerical or administrative, and a lot of those functions can be done from home more effectively. And that roughly those markets are like 18% vacant, and you're also getting those contractions coming. So I think great properties and great locations will survive, and there'll be some buildings that need to be repurposed over time. And I don't think we're going back to the way it was.
Yeah. Jaime, I know that office asset class is in your portfolio. What's been your experience?
So our office class is all suburban, and one of the things we're seeing, which is interesting, is tenants want us to have pre-prepared space. So in the past, tenant comes in, they know we need X 10,000 square feet. They design it. There's a long period of time for fit up. There's a greater desire now that we call white boxing the space, but it's ready to go. And I think that's a bit of a lack of commitment by tenants because they don't know. They don't know what their clients or what their employees want. I do know that programming of the office, and this speaks a little bit to what you're saying, programming at the office is becoming more and more important because we're literally begging teams to come back into the office. So I think there's just a lot of uncertainty. The other thing we're seeing is a lot of medical uses leasing up. So we've had a ton of interest from whether it's cosmetic surgery. I was trying to think of what it's called. I've never had it done. Cosmetic surgery, secondary type medical facilities, but it's a bit all over the map right now, I'd say.
I hear offering donuts every day gets people back in the office.
It does work. We do cookies, and everybody's in that day.
Yeah, it's a secret. Yeah, so you should open up a donut shop, right? Because it'd be busy. Andre, you've built a lot of office in your portfolio. You built this complex here. What's your experience been?
Yeah, so we built this building. We've got another building just across the way. They're under construction with Hoop. Over the years, we've built suburban and urban office. We're a merchant developer, so we own very selectively and we prune our portfolio. The office question, I think we've had an inversion or we've reached a point where things have really changed. I don't know that we're going to go back to a 5-day-a-week model, and I think that has to have an impact on office demand. I'm sure everybody here on the panel has observed the same thing. I walk through our space down on the 13th and 14th floor, and not bad. Tuesdays, Wednesdays, Thursdays, Fridays, Mondays are dead, Fridays are dead, and you walk around and you ask yourself, well, why are we carrying all this space? And personally, I would love just to say to everyone, this is where we work, this is where we conduct our business. This is a sense of community in terms of us as an organization. Everybody's coming back here 5 days a week. But I think that's just not going to fly anymore with employees. I mean, people have gotten used to, the flexibility. And I get it. I mean, people can multitask. If they need to pick up their kids, if they've got deliveries, they need to throw in a load of laundry. I get all that. But I don't know that we're going to go back, or maybe it's going to be quite a period of time before we go back. But I do worry in terms of what that means. Maybe I'm going to be the nervous guy on the panel.
Well, I think we should be put together because we completely have opposite views on everything.
So I mean, what that means, and again, like you even look at, we had a lunch the other day with the guys from CIBC, so they just moved into their new building at CIBC Square, which actually reminds me, Brian, I don't know if you're in the audience here somewhere, but they offered to give us a tour, which we should take them up on. But even their model, like they're working with like senior bank executives that are now hoteling, that are co-working. I mean, these guys don't have offices; they sit at big boardroom tables, sharing space with their analysts, and so I mean, I don't know how that all shakes out in terms of what buildings are survivors, what aren't, which buildings aren't, and I don't know about repurposing either. Like I do think in some very specific instances, repurposing office can work. Like we've looked at it a few times, but it's not a whole lot. And I read an article recently about Calgary, which has obviously got an even worse situation in terms of its office supply. Mm-hmm. And they're looking, you've got a funny dynamic, right? You've got probably too much office space, not enough housing. So how can you figure out a way to convert some of those office buildings? But it's challenging. How do you convert a building like this to residential? Yeah. Can't do it.
I think Calgary, that's a whole different scenario. That's a tough, I think it's probably 30% vacancy. They've got probably a 50-year supply there. I do think it's a lost opportunity, though, getting people back to the office. Mm-hmm. It's a lost opportunity for learning and mentoring the next generation. So I'm all for a hybrid solution, but we do need to get them back because it's hard to do it on Zoom. I think we're all that kind of in person. We like those face-to-face meetings. Those are valuable. You can't replace that with Zoom. So Ugo, I know you love office space, don't you? Huh?
Well, I definitely like it more than Andre.
Yeah.
Hold on. It's not that I don't like office. I'm just concerned about where it's going. And I totally agree that, I think you can't build culture virtually. You can't onboard people. How do you do that? It's impossible. So anyway, but it's just, I worry about, and I'd be interested to get your comments on, how that has shifted in terms of employee expectations. And if you want to retain your employees, and they've gotten used to working from home 1-2 days a week, how do you manage that?
Look, I have a little bit different view. I think that it's definitely shifted, Mark. Like it's definitely more flexibility has always been a mantra of ours, right? But I do think it's depending on the type of work that you do. Yeah. So, for example, our investment team, even during COVID, every time I shut down the office, they were yelling at me why I shut down, right? Mm-hmm. Versus more teams that were more invert jobs or more administration, they were happy to be at home. So I think there's a very dynamic difference in who wants to be in the office and who doesn't. And for us, we're back 4 days a week, 5 days a week, I'm pushing. But I can't build a culture in a company if people are working from home. We talk about people, how important they are. Well, on a Teams call, I can't build anything. And so I need the people to be back. Now, there's definitely some pushback on more administration jobs that they want to work from home, but I think that's about flexibility. And I think there's an overreaction. I think we, as humans, we always overreact to everything.
Yes.
And, 9/11 happened and World Trade Centers came down and no one said there was ever going to build a higher tower ever. No one's going to happen. They built 2 towers that are taller than what there was there before. And it was overreaction. And so I think everyone has to be flexible and provide flexibility, but as humans, we need to collaborate. We need to be together in order to come up with the best ideas, and I don't think you do that from teams. Yeah. And I also think that most people forget, like if you don't need to be in the office and don't need to be at work, then I don't need to have someone in Toronto to do the job. It can be anywhere.
Yeah.
Right? And so you probably shoot yourself in the foot, right? Like you can hire anywhere in the world if it's truly a work from home. Yeah. And it's a lot cheaper somewhere else than not in Toronto. Yeah. And so I think as leaders, we should be pushing everyone to come back. Now, it's not an easy thing to do, but I think it's it's within our wheelhouse as leaders of these organizations, especially in real estate, to get everyone back.
Yeah.
And it's like Toronto, when it's vibrant, downtown, is when there's people, right? When there's U.S. cities, when the downtowns are dead, that's when everyone's in the suburbs. A vibrant Toronto is a vibrant downtown, and that's meaning having people there.
Well, I am encouraged because I'm seeing it in Vancouver and I'm seeing it in Toronto here now. It's more lively. People are coming back. It's not. We'll never maybe get back to where we were, but we're heading in the right direction. Yeah. So let's move on to the next question. Andre, you're up on this. This next asset class is industrial, which has been the darling of asset classes, or certainly one of the darlings over the past few years. There's an article recently in the paper about Amazon, and Amazon has been had a big impact on the industrial markets around the world, but certainly in North America. And the article was announcing that they're going to shed 53 million square feet from their warehouse footprint. Now that's a bit misleading because they're not actually giving back 53 million feet. They're actually pausing 53 million square feet of projects, and most of them haven't begun yet. So you have to really dig into the details, because when you read the headline, you're like, oh, geez, that's going to dump a lot of space back into the market. And a lot of that is in the US for sure. So Amazon has had a very big impact on industrial markets in terms of the demand for space, certainly land prices. So, and they've contributed to lower vacancy rates. So if Amazon is pulling back on their expansion plans going forward, do you think this pullback is maybe, and a lot of these facilities are, the large ones are robotics, but they still have people in them. So is it maybe a case that they can't find the people for some of these, and they're just taking a pause, and maybe it's a case of just overshooting the runway and they're catching their breath. So you're big in industrial. How do you view this sector?
Yeah, so I mean, I think it is, in Amazon's case, a question of too much, too fast. And in a market like Toronto, as diverse as our industrial market is, I mean, if you look at Amazon's, like, I think their entire footprint in the market is 9 million square feet. So even if they decided to shut down all of that, and to your point, Mark, I mean, this is more of a pause than it is like giving back space. But even if you just went through that exercise and assumed that they were going to give back 9 million square feet, that's only 1% of the market. And so, you know, with vacancy rates where they are in industrial in Toronto right now, I mean, that's hardly going to move the dial. Mm-hmm. So, I mean, I do think they certainly have had an impact, and I think in a way, Amazon has been similar to WeWork pre-COVID in terms of their impact, kind of at the marginal costs and at rents. Like, even in markets where perhaps they weren't the dominant position, they did have an impact on rents. I think where you might see more pronounced impacts is in some of those secondary and tertiary markets in the U.S., where they are a much bigger component of that market. But in these large diversified markets like Toronto, I don't think it's an issue. And I mean, we're learning. We've got a data center project that we're working on where Amazon Web Services is going in there, and for us, it's been kind of an education, because we've gotten to understand a lot better how diverse and how big their business is. And they're slowing down a little bit on the industrial, maybe as a function of them kind of focusing a little bit more on some of their other business lines, which I think Amazon Web Services, I would think is probably their most profitable business line. So I don't see that having that big an impact. At the end of the day, we really like Toronto. It's fourth largest industrial market in North America. Mm-hmm. Yeah. Incredibly low, 1% vacancy rate. I mean, you can operate and buy and develop creatively when you've got vacancy rates of 6%. So I don't really see that impact with Amazon. And I think also in terms of some of the industrial fundamentals, there are a lot bigger and other demand drivers that are in the background. We'll touch a little bit on this, I think, later in the discussion. But even when you look at this phenomenon of reshoring, or I've heard it also referred to as reshoring, onshoring, or friendly shoring. And so with a lot of these kind of geopolitical issues that are going on, that's a huge impact on industrial, and you're seeing it already in the United States. So I don't think in big markets that is really going to matter.
My recollection of rental rates for industrial in the 90s and early 2000s where they were 5 net forever. They didn't even move a dime. and they've really risen. So I know industrial is a big part of your portfolio. Jaime, how are you? I know you like that asset class.
I do. So I mean, I agree a lot of what Andre said is that I think Amazon created headlines that are not indicative of the broader strategy. I think, we talk about industrial rents a lot, and to your point, $5, $6, it was stuck there for a long time. Now we're talking $16, $17, $18, and people think, well, how can it keep going up? And I think what's important with industrial, you have to remember that when you're paying your rent in an apartment, it's representing 30, 40, 50% of your income. When you're paying rent as a tenant in an industrial space, it's 5 to 10% of your costs. Your costs are actually labor, taxes, and so on. So for it to move the needle, it's not that significant. So it can continue to sustain rate increases. But the other thing is, for us, we made a really concerted effort to build space on more of that 200 to 300,000 square foot footprint, so that it had the flexibility that there wasn't only one tenant that could go in there. Parking the fact we did build a massive big bomber for Walmart, but parking that one exception, we did stick with that more flexible footprint, and it speaks to supply chain independence. That was a big issue when we saw how the geopolitical environment really blew up over the last 3 years. We weren't able to produce our own vaccines and store our own vaccines within Canada. There were a lot of realizations through that period of time that continue to feed the fundamentals of industrial, so we're very bullish on it.
Adam, you hate industrial, don't you?
Yeah, well, I think
So we put us
I hate to take a
together.
different view, and I'm not going to talk about Amazon because I think we've talked a lot about Amazon, and I think sometimes everyone has this view of industrial, these big 1 million square foot warehouses, and I think Mark, you and I drove around for 6 or 7 hours yesterday. How many big 1 million square foot warehouses did you see?
None. It's all small brick.
Right. So I think distribution's one thing, services are another. And City of Toronto is just ever more congested, and we're getting more and more people downtown. And I always say you can build a 100-story apartment building, you can't build a 100-story industrial building. So that land is like a finite resource in proximity to your customers. So we're super focused on flying under the radar, so I don't have to compete with you guys, and buying the smaller bay buildings with 5, 10,000 foot units that have 100 tenants in it. It's a little more work, but I guess that's what we get paid to do. And it creates this, it acts like very diverse, stable income flow, and we're able to take those rents from $6, $7 to $20 in this market because there's no availability. And so I guess there's a lot of different components to the industrial market other than the big bay distribution, and I think people forget about that sometimes.
What was interesting when we were driving around on Tuesday, which really stuck out with Adam and his brother Michael, was the parking lots were full, right? They were full. Like
we
all the
look for
warehouses.
parking lots where there's lots of BMWs and Mercedes in them. That way we know we can charge the rent a little higher.
That's why he's our partner. But that I was surprised. Like, it was interesting to see, like, all the parking lots were full. They were very active, so that was a good sign, as opposed to office space. So Ugo, you get to go last here on industrial.
I think it's a theme we all like industrial.
Yeah.
I'm actually a little pissed off to hear that Adam is going after small bay industrial. You stick to the big stuff.
We don't like the big stuff. We like the small stuff.
Look, I think industrial is a big sector. I'm not really going to repeat what everyone said on the panel because I think it's very similar themes. I do have to say that I was just in Europe recently, and industrial space is very limited supply there too. But one thing that they did was interesting, I think that we should be doing in Canada, is most of their long-term industrial leases, although 10-year, 15-year leases, are all CPI indexed on an annual basis. And for short-term duration, I think that's something that will happen to Canada, even though it's, we're usually, 5-year flat and then that's the next step up. But I think it's going to go, industrial space, because it's such a high demand. I think it'll be, we should look at more of the European model of having our lease rates CPI, indexed to CPI, and I think that'll be an even better thing to do for industrial space.
We try, but everyone says no.
I know, but if we all do it, then it'll be right?
The one thing I might add, sorry.
Yeah. No,
I was going to just
ahead.
add before we finish on the topic of industrial and the impact of Amazon. I think there's one positive impact to them slowing down. I mean, their expansion has been so rapid and they've been such a big consumer of material. And one thing, or one area where I think we're starting to already see early signs is material prices coming down. So I hear that from our estimating group on the steel side. And I do think that's actually, Amazon taking a pause is a good thing in that sense.
We're probably not talking a lot about construction prices, but we're seeing that as well. We're experiencing that with some of our projects out west, but we're starting to see a little bit of sign of some of the costs come down. So it's not where it needs to be, but it's heading in the right direction. So that's encouraging. Okay, we're going to move on to the next question. Ugo, build to own. And build to own, the strategy, which we like too, it allows you to build safe assets in the right locations. And there's always risk in building new product because you have to forecast out over a 3 to 4 year period, and navigate through the planning and approval stage, the construction stage, the lease up, and then stabilization stage. So a lot can happen in that 3 to 4 year time frame. There's a lot of variables too, interest rates, labor, materials, and now a new issue which we never we took for granted and called supply chain, which is materials and appliances and things like that. So, but in the end, if you do it properly, you can end up with a great product that probably will outperform buying an existing product. So what's your view on build to own?
I was reading this question and I was thinking, I agree with everything you said. So you basically answered the question. But look, we love to build to own, but I think you have to, before we talk about building to own and what you're looking for to build to own, I think you have to break out the development process into 2 different stages. There's the buying a piece of land or a retail mall, and then intensifying it and changing the use to get new density. And then there's actually the development part. I can't tell you today, in 5 years out, what construction costs are, what supply chains, what rents are going to be. So when we look at a development, we break that into 2 pieces. There's the land intensification, getting the density. And once we get that done, then we decide whether we're going to do a build to own and do that. So I think the development should be broken up into 2, not just one thing that we're just going to go and develop a new building. Having said that, once you get to the stage of development, the build to own concept is very much ingrained in us. We like building. We like the whole concept of building because you're building predictable cash flow for the long term. I don't necessarily know what the cap rate's going to be in the future or whatever, but I know if I do a building in multifamily or industrial, it will be full. Especially in multifamily, we know you can build it in the right location, it will be full because we're so undersupplied. And I think you're building long-term predictable cash flow. And as your presentation said, it's long-term predictable cash flow that's tax deferred. Mm-hmm. And I think that's a huge advantage. And when you're also looking at building these things, you have to, what you're building, right? There's a difference between building condo and building apartment buildings. You have to be very focused on operational issues and what you're building, making sure, in a condo, you're not really focused where your garbage is getting taken out. But in an apartment building, you are, because you're taking that garbage out a lot, right? Or how big your hallway is, because in a condo, you're moving in once, and maybe once every 10 years or 5 years. In an apartment building, you're moving a lot of people in always. Yeah. So you have to make sure you're building these buildings for the build to own for the long term. And we're more focused on building mid-market apartments than luxury apartments. I think the mid-market is a bigger market, luxury is a small pie, and you have to figure out how to build it for the big market. And lastly, on the build to own, because you're building these long-term sustainable cash flows, Mark, ESG is a big part of it. You have to build it in an environmentally friendly, the best way. You have to use technology, as Andre said, to make the building more efficient. You have to try to get to net zero. I'm not sure it's possible, but you have to. You have to build these that are sustainable for the long run, and climate change is a big issue, and we have to be aware of that when we build it. So I'm a big proponent of it, and I like it because you have a cash flow stream that will last 20 years, or at least 20 years.
Well, we'll be talking about ESG in a second, but I do like the build to own because you control the quality, and that's really important. So, Andre.
Yeah, we like build to own. I mean, we like building assets that you can own. We'd like to build a bunch more of them for you. We own very selectively. We are a merchant developer. But when I read your question and all the different challenges and all the risks you take in a build-to-own strategy, I couldn't help but think about this project that we've got across the way here at 25 Ontario. I mean, we built that office in what must be the most challenging period of time for office development in the last 25 years. I mean, we've been hit with everything. Interest rates, check. Approvals issues, check. In fairness to the city, not so much city, more utility oriented. Global pandemic, construction cost escalations. But at the end of the day, I totally agree with the point that you're building a quality asset at a great location. I mean, is Hoop going to regret investing in that build-to-own asset? Absolutely not. I mean, this entire downtown east location just gets better and better. You've got a subway stop coming, who knows when, but it is slated to come. And I mean, it's a quality asset. We broke the back of the leasing prior to COVID, fortunately, and those tenants are going to be there. And it is going to be, really outstanding office building built to the highest standard. And again, I may have given the impression earlier that I was negative on office. I'm not negative on office. I'm negative on some office. I think new office is always going to perform and perform well. I worry more in terms of the overall inventory and some of the other B and C buildings.
So Jaime, build-to-own is a big part of your program.
Yeah.
Tell us about the certain asset types you like and the markets.
So Ugo brought up a good point, is I think it's important you bifurcate the risk associated with buying land and getting the land entitled and going through the municipal process. And we actually separate in our portfolio because the risk appetite around that is very different. And when you're done entitling it, you can actually just sell it if it's not something that you plan to develop. No, build to own, at the end of the day, it's 70% of our portfolio is under development. We're hoping that at least half of that will be build to own, because that's how you accumulate assets, that's how you accumulate wealth. And by building it new, taking the care that everybody has talked about and doing it properly, making sure that it works for the neighborhood that it's built in, if it's a residential, and then the reduction of the CapEx exposure is that when you buy existing buildings, you don't know what's behind the walls, you don't know if the balconies need to be replaced, you don't know if there's a risk in the parking garage. You've got the certainty that what you built, you know the quality of what you built.
Are you doing build-to-own yet?
No, I'd say that's the dream. We're more entrepreneurial than, I wouldn't say more entrepreneurial. You're all large and institutional. And we're the new guys on the block. We're the new guys on the block.
Those are fighting words, Adam. Come on.
Exactly. But anyway, so we don't have the benefit of I guess endless money with no time horizon on it. So
and we do.
We have to actually turn our capital more quickly. So, but I'm a seller of anything we do. So if you guys want to buy it, you're welcome.
Okay, I'm trying to cover all the food groups, so we're going to move on to the next topic here, which is retail. And Adam, I'm going to start with you on this. So
terrible asset class.
Yeah.
Yes.
It's
I got all the good ones.
It's a swear word. So certain types of retail really took it on the chin during COVID, as many retailers had to close, and particularly the shopping malls, the enclosed malls got hit hard. So as we have emerged, I think we've emerged from COVID, retail seems to be emerging nicely. So how do you view this asset going forward? We own a couple with you.
Yep. Listen, I think...
And do you think it's been impacted by e-commerce, right?
Listen, I think retail was challenged well before parts of retail. Like retail is really, enclosed malls, power centers, and neighborhood and community strips. And the neighborhood and community strips are normally daily needs, service-oriented. Power centers are all the things you go to Best Buy and Golf Town and buy, and enclosed malls. I haven't been in one in a long time. So I think they're all totally different asset classes that are lumped into one thing. And I think way before COVID, enclosed malls were challenged. E-commerce was around, and that trend was happening. And same with power centers. I think there's a huge issue with the lockdowns and tenancies being lost. So I actually called some of my retail leasing friends about 10 minutes before I got here. And they told me that malls are leasing up and that people are coming back. And that was kind of surprising to me. So, and sales are generally close to where they were before the pandemic, maybe 10% down. So I think overall, The retail leasing has come back, and I think that's good, but there's still structural issues in it, and it's really like retailers have long-term fixed leases, and they don't really adjust to inflationary environments that well. So I think that's also a challenge for the retail sector.
Jamie, do you have much retail in your portfolio?
No, actually, we have a really small exposure to retail, and it ironically performed the best of the entire
Really?
our asset classes. But I think there's a real shift towards experiential retail,
Yeah.
right? Is that what we've learned is that we can use Amazon, we can use e-commerce to buy the commodity, and so our desire to go to retail in person is more a function of the experience itself.
Ugo?
We do have retail, and we have bought a few retail chains, but we have bought more needs retail, like retail, grocery anchored, shoppers. We liked it. It performed the best during COVID.
Yeah.
So we do it does fit a part of your portfolio. Yeah. So I do think it fits in. And I see the clock running, so
I know it's like
Clock's on.
Oh, okay, Andre, I didn't notice that. Andre, I know it's an ancillary use, so retail is part of a project, but you're not really a big retail
Yeah, no,
developer.
we have about 1.2 million square feet of retail and kind of a mixed bag, some of the old power center stuff, some strip center stuff, quite a bit of urban. I would generally agree with the comments that have already been made. And it's an interesting asset class because you can't just paint it with a broad brush, retail. It's very discrete in terms of what types of retail, and I totally agree with Jamie. It's about placemaking, about experience. I think and it's also about community, right? We talked about that in light of the office, but I think retail, too, a big part of that community. And it's very interesting to see how creative some of these retailers are. Retail, arguably, that's the one asset class where, that it's subject to the most change and the most rapid change. But, like I look at my daughter, she works for a bike shop here in the city, Bateman's Bicycle Company. And I mean, this is a family company, in a couple of stores. I cannot believe how creative these folks are in terms of building a sense of community. Their service level is just off the charts. And it's far more than just going to a bike store. I mean, it's really an experience, a community. They do group rides, they teach riding. So, retail, again, it's going to be another survivor, but it really depends on which type.
Okay, I'm going to get roasted if I don't ask this next question, and then we're going to have, after this one, we're going to have sort of rapid fire question answer for you, and then we're going to open up to the audience for questions. So, Jamie, this is front and center on your website, ESG, which stands for those who don't know, environmental, social, and governance. And Jamie, I'd like you to touch on that, what your policy is and how important that is for your company.
Yeah, so ESG, the way I describe it is when I used to do investor decks, ESG was like page 28. Now it's page 2, because it's important for us to show to investors that ESG is a huge component of what we do. Everybody talks about the E, which is the environmental, whether it's your solar panels, net zero. We can all talk about that. It's table stakes. That's just expected that you're working towards those type of metrics. What's really important to us is actually the S. I think about, we use terms DEI. We call it EBID, equity, belonging, inclusion, diversity. That is, I chair the think tank that we have in-house, and pushing that in terms of our industry and what our workplace is made up of is important, because once we can say to ourselves, we have a diverse workforce, diversity of thought, we can start to have influence with our vendors, our investors, and say, we want you guys to start to look like us, right? So it speaks to some of the workforce discussions that we've had. And one of our biggest investors, LIUNA, the laborers' pension plan, human rights, worker safety, all those things are just as important when you're talking about ESG as it is to look at emissions and you're thinking about climate change. Oh, phew.
It's the ESG is such an important topic, and I think a lot more education is required, and I think it's going to happen. But do any of you want to comment on ESG?
I feel like the time card was like the poker thing.
Because I want to ask you
your time card.
But Jamie handled that so well.
Exactly, it was good.
Yeah, I think it's table stakes right now.
Okay. Okay, so last question, rapid fire for each of you. And I'll start with Jamie. So in the next 6 to 9 months, what do you see as the biggest threats, and what do you see as the biggest opportunities? And we'll go down the line here.
So I think threat is panic, is that people are going to panic in the current environment, whether it's the consumer, whether it's the investor. Again, real estate is a long-term asset class that we're investing in. We have a short or medium-term blip in the economy. The flip side of that is the opportunity I see is that I think there will be distressed assets and distressed opportunities that groups that are economically conservative, like a Fengate, will be able to take advantage of that.
Yeah, being well capitalized is probably a pretty good thing right now in this environment.
Yeah.
Adam?
Yeah, exactly.
Threats and opportunities.
I think, listen, you touched on it in the presentation earlier. It's things that are out of our control that we can't anticipate. So is that regulatory, i.e. interest rates going up, or rent controls, or is it geopolitical? Is it the Russians using a tactical nuclear weapon, and what does that do? So those are the things that I think are the threats, because we have no way to control them and no idea how to. And I think if you're a real estate investor, you have a long-term view, and having a long-term view in Toronto throughout the cycles is the opportunity. That's what I think.
Okay, Ugo?
It's really funny listening to Jaime and Adam because they've taken all my ideas before, and actually I wrote panic down as.
I looked at your notes.
Yeah, I know. I think the biggest worry or biggest obstacle I think keeps me is the stuff I don't know. No one would have predicted a pandemic, right? And I think the stuff that, besides that, I think political intervention is the biggest risk to the industry that worries me the most, because there is a huge supply and demand imbalance, and political intervention always does the wrong thing. As an opportunity, I do believe there's opportunity because there's such a supply and demand, and frankly, it's panic. Don't panic. Like, opportunity is created when people panic, and when people don't know how to deal with it. And if you're a steady ship and not calm waters, you'll get by quite nicely. And I think the opportunity is to be a level-headed in this environment, and I think there's going to be a lot of opportunity.
Yep. And Andre, last but not least.
Yeah, I would echo a lot of those comments. I mean, in terms of threats, I am concerned about inflation, the pressure on cap rates, and what that does to our underwriting. In terms of opportunities, I think recession is fully baked. Whether that's a 12, 18, or 24-month recession, how severe, who knows. But the most accretive acquisitions that First Gulf and the Great Gulf Group more broadly have made were made during periods of market dislocation. And so, whenever there's these periods of upheaval, it creates opportunities to buy, right? There's a bit of fear sets in, panic. And, if you can keep your head about you, as Ugo said. And, for us, we're always looking at the exit. Okay, what is the most conservative exit that we're comfortable with that will ensure, hopefully, that we make a little bit of money, but at worst not lose any money. And then everything is above and beyond that. Like this whole block we bought after the 2008 crisis. And what you see here is not the vision that we had in our minds. It was very, very modest. It was like, let's buy that vacant building, put in George Brown, see if we can't turn it around for a bit of a profit. So as long as we're comfortable with a very conservative exit, that's good for us. But it's also easy to say, like we buy in periods of fear. When you're in periods of fear, it's hard to buy. Like it's easy to say, yeah, we'll those periods of market dislocation, we're going to be buying. But it is also very challenging to make those calls. And I'm starting to sense a bit of fear, like the pendulum is swinging. The old truism, markets are driven by greed and fear. And I remember 2008, and I'm curious to get anybody else's thoughts. Like I remember there was a palpable sense of fear in September and October. And for sure we're not there, but you're starting to get little subtle hints. That people are getting a bit afraid. And so again, opportunity, right? If you can keep your head above you.
Yeah. 2008, 2009 was the best time for us.
Yeah, same here. We made the best acquisitions that the broader Great Gulf Group made were during 2009.
So great discussion. I do want to leave a bit of time here for Q&A from the audience. Before we wrap up, first off, I want to thank Danielle and Ethan for a great presentation. So well done. Thank you. I also want to thank all the Nicola Well staff who really work hard to put an event like this together and make my job and the panel's job easy. So thank you for all our staff for their hard work. And people, right? That's people.
Yep.
And then I also want to thank the panel because I'm just honored to have all of you. You're first class, and I think it's great for our audience and clients and friends to be able to hear your expert opinions. So the audience can join me in thanking you for coming today. So before we go for refreshments in the back, if there's anybody that's brave enough, I do think we have some Nicola Wealth people with microphones in the back. You can put your hand up, or you can stand up and ask a question if you have a question for the panel. We'll do 2 or 3 questions. Does anybody got a question?
Yeah, hi. My name's Nitish. I'm an MBA student from Ivy Business School. Thank you, Mark, and the panelists for doing this for us. My question to you is that given that there might be an issue of aging social infra in the form of schools and hospitals, primarily in US and to some extent in Canada, do you see private players, especially investment funds, entering that space or not in the future?
Sure.
I missed the last
We couldn't hear the last part of that question.
Sorry. So just to repeat, I'm just asking if, do you see private players and especially investment funds entering the social infra space in the future?
So your question is whether we enter in the social infrastructure space? Well, I can talk to Fengate. We actually have an infrastructure line of business, and so yeah, very much. So we're very much evolving from that sort of traditional, more P3 infrastructure investment into the social infrastructure space.
Anybody else that has a question? Shy audience. I guess you answered all their questions. Nobody else? Well,
Or they're asleep, Mark.
Yeah, we put them to sleep. Okay. Well, thank you everybody for coming tonight. I hope you enjoyed our presentation, and